Two close boyhood friends grow up and go their separate ways. One becomes a humble monk, the other a rich and powerful minister to the king. Years later, they meet. As they catch up, the portly minister, in his fine robes, takes pity on the thin and shabby monk. Seeking to help, he says, "You know, if you could learn to cater to the king, you wouldn't have to live on rice and beans." To which the monk replies, "If you could learn to live on rice and beans, you wouldn't have to cater to the king." Yes, you've read it right from the title and the thumbnail. Becoming wealthy is simple. That's what I've gotten from this book I recently read. The Simple Path to Wealth, Your Roadmap to Financial Independence and a Rich, Free Life by jlcollins. The little story I told you at the beginning of the video is a beautiful parable at the beginning of the book which resonates with me a lot. But what I want to share with you in this video is the key messages I've gotten from this book. Some premises are necessary. I am not sure I would recommend this book to non-US citizens. The reason for that is that many of the suggestions and recommendations written in the book are really specific for Americans. He goes quite into detail with retirement plannings, 401k, IRA, Roth IRA, taxes, Social Security, healthcare insurance. Really specific things for Americans. As the title suggests, this book is about building your wealth in a simple way. As money is the most powerful tool for navigating this world, understanding it is critical. He refers to reaching financial independence to having FU money. The idea is to have the amount of money and resources to be free to do whatever you want, whenever you want. We could overall sum up the book really quickly in this way. Avoid debt, spend less than what you earn and invest the difference to build your wealth over time, live off your investments while preserving your wealth. Really simple and concise. The thing that I really love about this book is that when you read it, it doesn't really feel like you are reading the words of a financial planner telling you some intricate way to invest your money and become rich. It kinda feels like a dad teaching his children how to deal with money. And do you know why? Because this book is a summary of the content of jlcollins' blog. And he started his blog as a way to archive and store information and advice that he wanted to pass on to his daughter. Then the information collected in the blog spread to the world, where hundreds of thousands of people made treasure of it. So that's part of what made this book so successful. I divided this video into a series of main steps toward wealth. So let's begin with step number 1. Avoid debt. I overall agree with this point, but not really 100%. Nowadays, debt is accepted as the norm, and you have the possibility to buy things you cannot afford, which is often a problem. He is quite strict against debt. It seems like he wants you to avoid it at any cost. To me, debt is a powerful tool when used in the proper way, and there are two main things to consider: inflation and opportunity cost. If on your debt you have a low, fixed interest rate for a long period of time, and in that period of time the average inflation is superior to the interest rate, then at a certain point it will be like you were actually getting paid for getting the loan. On the other hand, if the money you received is invested, for example, on your own business, with a return higher than the interest rate of the debt itself, then it is worth getting the debt. Also, you have to consider the opportunity cost. Imagine getting a loan and investing right away that money in a broad index fund that tracks the S&P 500, which is not something I am suggesting, and also, you will never receive a loan for that, but this is just for the sake of the example. Historically, the S&P 500 returned on average roughly 10% a year. Now, of course, we cannot predict the future, and be sure we will have that average 10% back a year, but chances are that the money you invested over a long period of time may yield a return higher than the cost of the loan itself, if the interest rate is low enough, of course. So with all things considered, in similar situations, it would actually be profitable getting debt. So personally, I wouldn't completely demonize debt. You need to give it more context. How are you using it? For what? What's the interest rate? And how long is the term? To be fair, at a certain point, he does mention that if you have a debt with a low percent interest rate, he says less than 3%, you can pay it slowly over time. But I believe that this point should be highlighted more. Not only you can do it, but it may be something to encourage. The thing he mostly recommends, and with which I agree for sure, is to avoid high interest rate debt, like the one you could get with credit cards. If you already have high interest rate debt, pay it back as soon as possible. Make it your number one priority. If you have different kinds of debts, start with the one with the highest interest rate, while paying the minimum amount required on the others, and then move toward paying the ones with the lowest interest rate. Step number 2 is spend less than you earn and invest the surplus. The concept of spending less than what you earn is related to the previous topic of avoiding debt. Then, if you decide to pursue financial freedom, you are going to have to choose to spend your money on investments. Somehow, in our culture, this has come to be seen by most people as deprivation. To me, investing means using my money to buy time and freedom, which is something I value way more than any materialistic thing. About investing, he is quite clear. Investing is not complicated. People who make it complicated are the ones who want to profit from it. So, what should you invest in? Invest in broad-based index funds. His strategy is either an index fund that tracks the total US stock market, he specifically invests in VTSAX, or the S&P 500. You may also add a fraction of bonds index fund, again, he suggests VBTLX, and adjust the relative amount according to your age and goals. The older you get, the higher the fraction of bonds you may consider to add. But if it is so simple, then why do most people lose money in the stock market? I'm going to answer this question with a few lessons from the book. Before starting investing, be sure you can handle your emotions. This is crucial, as there are studies that show how the average return of investors in certain index funds are lower than the returns of the index funds themselves. How is that possible? You may think, of course, because there are fees to consider. That's true, but that's not the point here. People have lower returns because they tend to get in and out of the market, selling low when the market is going down and buying and getting in again when the market is up. Market downturns are normal. As scary as it may be, you should embrace the market going down, as you should see it as an opportunity to buy more shares of your index fund. You can't time the market. If you were able to time the market, you will be richer than Warren Buffett. He can't time the market either. Nobody can. In the book, he makes a good argument against dollar cost averaging when you start investing for the first time and have a lump sum of money to invest. And he is right. Statistically, you are better off by deploying the money all at once. The only risk is that right after you invest the money, the market will go down, which might happen. But the chances of dollar cost averaging and having the market going down right in the period you are dollar cost averaging are pretty low. Still, I believe this is something very hard to achieve, as I, myself, preferred starting investing my money through dollar cost averaging, and since I started investing in October 2021, it was a good thing for me. But the truth is that I've just been lucky. I've done it just because it was too scary for me to invest everything all at once, and honestly, I want to be able to sleep at night. At the end of the day, you are treating one risk. The market drops after you buy, with another risk. The market continues to rise while you dollar cost average, meaning you will pay more for your shares. So which risk is more likely? Statistics say that it is the latter. You can't pick individual stocks. I will agree to recommend it as a generic advice for most people, but I wouldn't say it is necessarily right for everyone. You have to remember, you are not simply buying some ticker symbols that are going up and down over time. You are buying fractions of companies. With this perspective, you may find value in owning stocks in specific companies in which you really believe in and that you believe are fairly priced. But that's a long and complicated topic which I'm not going to discuss in this video. For now, let's just agree to buy index funds rather than individual stocks. Avoid mutual funds and financial advisors. Mutual funds are funds actively managed by a manager. You should avoid them for a couple of reasons. Number one, over a long period of time, most of them perform worse than the stock market. The longer the time frame, the lower the number of mutual funds that perform better than the stock market, up to less than 1%. With part of that may even just be caused by luck. Number two, they are expensive. They may have fees higher than 1%, which doesn't seem like a big deal, but compounded over a long period of time, is gonna make a huge difference. Regardless of what their performance is, their fees are gonna stay there. So even in the case they perform slightly better than the stock market, they will have to make that extra percent up to cover their fees to justify purchasing them. I will generally avoid financial advisors, as their interests are necessarily against yours. They are incentivized to sell you some intricate financial tools with very high fees that are most likely going to perform worse than the stock market. I'm not saying that all financial advisors are bad, but choosing a good one is probably even more difficult than picking winning stocks or actively managed mutual funds. Don't focus on the foam. In the book, he makes this well-put analogy of the stock market and a glass of beer. If the stock market was a glass of beer, you will have the beer itself, which represents businesses of which we can own a part, and the foam, which represents the ticker symbol going up and down every day, the news from CNBC, all the gossip around the internet, etc. Now imagine getting your beer served into a dark mug you can't see through. That's the stock market. You don't really know how much beer and how much foam there is. So stop bothering listening to all that stupid news, because it's quite pointless. So these were the main reasons why most people lose money in the stock market. Now, there is a really important message that the author tells you. Investing in index funds doesn't mean having average results. It just means you're having the same return as the overall stock market. But considering that most mutual funds managers underperform the market and that a lot of people lose money for the reasons we previously mentioned, you're actually having results way above the average person. Simple things give better results compared to complex things. The third step is live off your investments while preserving your wealth. So the author of the book divides the investing life of a person in two main periods. The wealth growth period, which is the period we just talked about a moment ago. This is the period where you are working, you are spending less than you are earning, and you are investing the difference. In this period, you should be inclined to invest more aggressively, mostly in stock index funds and maybe with a fraction of bonds index funds. Since even if in the short term you may have some downturn, over a long period of time, the stock market should keep going up and you will be fine. Then we have the wealth preservation period. This is the period where you ideally stop working and retire. You don't necessarily have to stop completely, but if you want to, you have the choice to stop. You live off your investments, so you switch more towards owning less stocks index funds and more bonds index funds. Of course, it's not a net separation between these two periods, and the asset allocation doesn't have to be precisely equal for everyone. If you're even too lazy to allocate your money in different index funds, there are TRF, Target Retirement Funds, which are tools that do that automatically for you. So at this point, the question is, how much of my money can I spend to be sure I won't run off? Well, you may be happy to know that there is a study from Trinity University that tried to answer this question. I'm not going too much into detail, because we could really make an entire video only on this specific topic, but the generally accepted answer is 4%. But why generally accepted answer? Because there are actually some nuances to consider. The study was conducted considering how much you can withdraw, making sure you won't run out of your capital over a 30-year period. It was made considering different capital allocations, different proportions of stocks and bonds, and with 75% stocks and 25% bonds, you had 100% chances to not run out of money. Then, in most cases, you could withdraw slightly more and still end up with a capital way larger than what you started with. It also depends a lot from person to person, how flexible you are in adjusting your spending on bad stock markets here. If you have some passive sources of income, how willing will you be to do some extra work if necessary, etc. I mean, of course, nothing has to be precise and strict, but you get the overall point, and you need to realize that fear and risks are often overblown. Then, there are some sections in which he goes really into detail and that are mostly specific for Americans, like buckets to invest in, like 401k, IRA, Roth IRA, healthcare insurance. Like, for example, for me, that I live in Italy, healthcare is basically free. Social security, here again, he goes into details, but there is a part that I really love and that really resonates with me. Plan your financial future, assuming Social Security will not be there for you. Live below your means, invest the surplus, avoid debt, and accumulate FU money. Be independent, financially and otherwise. If, when Social Security comes through, enjoy. Charity and related tax deductions. And this is something that I really feel the need to say. I can't see the point in this kind of books for these parts. Like, what to do with your money when you're rich, how to give away for charities, what to do when you are rich, have infinite time and are depressed because life has no meaning. Like, just write another book on that specific topic if you want. That's more philosophical stuff. Let me deal with one problem at a time. First, let me get rich. Then, let me worry about what to do with my money and my time. I may even die before I get rich. So why should I bother now how to give away to charity? So this was The Simple Path to Wealth. I overall enjoyed this book. I think that the ideal target for this book are people who don't really want to bother spending time learning about finance and investments. Again, the book is mostly recommended for US citizens. I personally give this book a rating of 3.5 out of 5. See you on the next one. Bye.